All right. Welcome, everybody, to Around the Desk. I am Sean Emory, Chief Investment Officer and founder here at Avery and Company. We are here with Alex Morris, TSOH Investment Research. If you follow him online, he puts a lot of great stuff out there. Looking at his portfolio, Dollar General, Dollar Tree, the dollar stores in vogue, with Alex here. What I appreciate about your work, Alex, is, really around the level of research I think you do in many of these names, but also doing it openly. We believe in a pretty high level, being open, transparent about your research process. We're running a strategy and a fund, but you're running more of a research, solution over there, and really just spewing, a lot of the deeper focus on, business quality, capital allocation, long-term earnings power of many of these businesses. So appreciate you coming on today and sharing a little bit about, some of your names, but then also some of your philosophies. So again, thanks for being on today.
Yeah, thank you for the very kind intro. I'm excited to do this.
Yeah, so let's start with, stepping back, I think, before we go into one of your names, which is Dollar General. But we'll go there. But before that, share a little bit about, how you ended up here, with the philosophy that I think, you see Munger behind me on one of my shoulders here. I think you have some of the roots that we share, which is, forward looking, but still valuation driven, capital allocation driven at the business level, let's say. But just share a little bit how you even got to this point.
Sure. From a professional perspective, so I went to college in the mid 2000s, and when I first got there, I really didn't know what I was going to do. I had some kind of entrepreneurial leanings when I was younger, but nothing that necessarily was going to lead me down the road to investing. So when I first went to school, my dad's a plumber, so I went for building construction. Um, and I'm not sure where that track where I got off track there either. I don't know if it was lack of interest or if it was some of the classes in physics and other things were a little bit challenging for me. So I would an easier route than building construction, I guess, which was finance. And my love of finance and business really kind of got started as I remember one summer where a buddy and I kind of stumbled onto the Berkshire Hathaway shareholder letters. So that was, almost 20 years ago now at this point. And that kind of started an obsession and love for these topics that, continues to this day. When I was going through school, I went to the University of Florida. As I was getting closer to graduation with a finance degree, I wanted to go work at, a hedge fund or a mutual fund or something like that. And as I sent out a bunch of resumes, the response was pretty consistent in terms of let us know when you have a CFA and let us know when you have an MBA and 5 years of experience or whatever it may be. And I had to get from A to B, which was a bit challenging to figure out. So around that time, I started writing online as a way to kind of bolster my resume and try to build that network a little more. So fast forward over time, I eventually did get a job as an equities analyst at a really small RIA. Later on, moved to a larger RIA in Savannah, Georgia. Um, but throughout that 10-year period where I worked in the industry, I was still writing online and building those connections and kind of testing my own analytical process and communication abilities, which apparently I had a lot to learn because some of the early work was not particularly good. So yeah, I kept working at that over time and got my CFA, got my MBA, all those things. And as it came to 2021, I looked around and saw people like Ben Thompson, Esther Teckery, Scuttle Blurb, MBI, Most of Art Ideas, people like that. Talked to some of these people and decided I'm going to take a shot at selling my research directly to people, basically through TSOH Investment Research, which the kind of the core idea is 100% transparency, as you kind of put it. Complete transparency around everything I own and why I own it, prior disclosure of all changes. Just really, as I looked at finance or think about finance, I think at times the discussions can be a little bit surface level or not really hitting on the points that matter. And that was a bit of a pet peeve for me that I wanted to try to go the opposite direction on, which is certainly uncomfortable at times when you're trying to really explain why you're doing some things. And sometimes it's a little bit more field and science, right? Or you talk about something and you get it exactly wrong. Those are not enjoyable conversations necessarily, but I think that's a really important part of one, building trust with the people who subscribe to my service, and also honestly this continued uh, progress in trying to improve and figuring out why something went wrong or didn't go as expected. So that's been kind of my journey in terms of the professional stuff. In terms of my investment philosophy, I when I first started buying things in the, call it mid to late 2000s, it was the things that in my mind you probably shouldn't be doing, right? I was buying solar panel companies and micro caps that I didn't understand at all. A lot of things that were not too well thought out and with the outcome that they deserved for not being too well thought out. As I learned more about, value investing and Warren Buffett and Charlie Munger and started to take some of those things to heart. Probably the most informative investment during that period was buying Microsoft, and I bought it in 2011 and I still own it today. And that journey of it going from a kind of more traditional value stock with a low PE to what it is now, and seeing the business change and the importance of Satya Nadella's leadership. Just been so many lessons in there that have kind of informed how I continue to think about investments to this day. And if I had to pick out a few things, it'd be quality of the business and the management team, which I kind of view as really closely tied at the hip in terms of as time goes on and the decisions that management makes. They can turn a good business into a less good business, and they can turn a decently good business into a better business based on the decisions they make. Um, Long-term holding period, um, relatively high levels of concentration in the portfolio. So those are kind of the core things that are still kind of at the heart of my process and the implementation of that process.
Got it. Yeah, we share a lot of I would say commonalities in terms of our, general beliefs. Other than that, you were a Gator, and I'm a Gator hater. But other than that, you're also, you know, we spoke about this, before we turned this thing on, which was the science of hitting. Take us into a little bit of the world of why baseball, why is baseball such a what seems like a big part of um your, aura around the investment world.
Sure. Well, I love sports. I love baseball. I'm a huge Cleveland fan, as we were discussing, which has not been particularly enjoyable some of the last couple of years. Um, but yeah, I mean, that was somewhat by happenstance when I was going through that period, when I was coming out of college and going to get a job in the industry. The ability to keep writing online and posting things online under my name was not going to be allowed. So that's why I had to come up with a pseudonym. And at that time, I picked the science of hitting, or TSOH now, which is, for people who don't know, it's a reference to the book by Ted Williams about basically the sweet spot of the batter's box and waiting for the right pitch. And Warren Buffett's version of this is, in baseball, the batter standing there, and if it's a curveball in the outside corner, but if he has two strikes, he still has to swing. Otherwise, he's going to strike out. And in investing, there's no called strikes. You can stand there and wait for the pitch and swing big when it comes across the plate. So yeah, that's kind of the inspiration for the name. And I think over time, thankfully or luckily, it's still very closely aligned with how I think about the investment process, which we'll get into on some of these names we're going to discuss.
Yeah, no, interesting. I mean, I often write about, baseball in general in the grand scheme, as it relates to investing. I think one analogy I like to use is just, the failure rate of a, successful hitter, which is, part of investing is around psychology. And, you're going to have, periods of perceived, I guess, failure. And not failure to the end, right? Like not failure where you have failed, but where things aren't as perfect. You've struck out twice, but you still have to come up in the, the ninth inning, against the closer and try to get a hit, and you kind of have to brush everything else off and kind of move on and get to, the batter's box, like you said. So I think there's a lot of analogies from, again, how many looking for that right pitch, but then having the fortitude that when things get a little shaky out there, whether it's macro stuff and the markets are moving and, COVID hits and markets down 20% and you feel this, pit in your stomach. If you've played baseball, if you watch baseball, then yeah, you felt that pit before. And it's just, another moment in time where you kind of just go past it and stay disciplined and keep moving forward with your process. You take the same swing, right? Your swing doesn't change too much. It's more your brain and how that tricks your body into moving a little bit differently. Now let's go to maybe some of your names. I know you run a concentrated portfolio, um, and we spoke here over the last, call it, couple months, really just trying to hone in on which one, do we want to talk about? And when you run a concentrated book, we can talk about them all, right? You know them all very well. We run a concentrated book, 12 names as well. So it's very, there's a lot of similarities here repeatedly. But, Dollar General, DG, none of this is, again, just for preemptive purposes, and not investment advice for me or him. And again, we'll have, some of the disclosures here, but let's start with Dollar General. How'd you land there and kind of what makes it exciting for you?
Is real quick, I was going to say on your other comment, I think it's worth pointing out. I like the way you framed it in terms of how much of it this mental part of the game, whether it's playing baseball or playing golf. I'm sure people can appreciate that, and investing, and this idea of having a process or a philosophy that aligns with your own, obviously your own financial situation and ability and willingness to bear risk, but also your mental and your, kind of the biases that you have to navigate, which everybody has different things. And that's where, especially for someone who's newer to investing, that's where ideas on concentration and diversification and those things, I think people a lot of times come into the game and have a black or white view of, I mean, myself included. There's things I believed more vehemently when I was younger that I've definitely cooled on over time and appreciated that there's different answers for different people, right? And I think that's an important part of playing the game, even though when you then go into, as we'll talk about something like a DG, you go into the individual security selection, it shouldn't necessarily matter, but those building blocks are hugely important in terms of how you actually apply that. So I think it's important for people to think about, especially younger investors. Um,
Sure.
DG is, in my mind, probably the most telling thing that you can say about the company is a quote from a former CEO of the company in the early 2000s said in relation to Walmart, "We went where they ain't," was his way of framing it. And that's really DG's story. Is there's roughly, I believe, 21,000 stores at this point scattered throughout the US. Vast majority of stores are in the US. They have 10 or 15 stores in Mexico. Um, but the strategy is to be in smaller towns and to offer, the retail value equation for any retailer, or especially for, consumables retailer, grocery type retailer, is some combination of, store quality, product pricing, and convenience, I'd say, are really the main things. And DG's pitch is effectively, we will offer much higher convenience relative to the Walmart that may be 10 minutes down the road or 15 minutes down the road for someone who lives in a smaller town. It's a minute drive to come see us. You may pay 5% more for the products, but we're selling convenience basically. And I think there's a lot of merit to what they've done in that regard over time, which is evident in the results to some extent. They've also, in my mind, been really effective competitor to other players kind of like them, most notably kind of like the drugstores, things like that, and smaller mom and pop type grocery stores. So that's kind of the core idea in my mind. How that's now evolved over time throughout the pandemic, and also kind of the rise of e-commerce and omni-channel, most specifically at Walmart, who in my mind, is kind of the main competitor, and a company that has, under the leadership of Doug McMillon, I think been really, really well run, got focused again on what was important to the core US business. And it's taken a long time and a lot of work, but over the past 5 to 10 years, they've really gotten into a much better place where e-commerce is now really driving a lot of the business. And specifically as it relates to competing with DG, a lot of the buy online, pick up in store, or the delivery options they've become much better value in terms of the quality of the offering and the price of the offering than what Walmart offered at one point in time. So that's been a competitive issue for DG that they've been navigating. The other issue has been, again, this kind of roller coaster of pandemic tailwinds and headwinds. has really taken a hatchet to the P&L in the last couple of years in terms of them getting their cost structure where it needs to be, getting the margin profile back to the area where it was historically. Um, so yeah, the company's been navigating these considerations, and anytime you have a stock that goes from, I think at one point it was probably $250 a share, and um, it probably got to, I want to say, $60 a share in the past 12 to 18 months at some point in time. So a ton of volatility, right, for a pretty straightforward business. But as going back to the mental thing we were just discussing, anytime a stock goes from 250 to $60, doesn't matter how straightforward the business is, right? As you and I know, the questions start. It's a little more nerve-wracking to answer the questions about the sustainability of the model or the sustainability of the P&L, et cetera. So yeah, it's been a very interesting period where I think I think it's fair to say they've had some what you could probably call deferred maintenance that they needed to do in terms of just the quality of the model and the cleanliness of the stores and keeping shelves stocked, et cetera, et cetera. And I think they've now started to get that back to where it needs to be. And now they're moving into things like delivery from the stores in a way that I think can be much more competitive with where the landscape and retail is kind of going generally.
Got it. Stepping back a little bit, the like what is the market, I guess? What have they been skeptical about? Like what has created that um I guess lack of the dollar stores for a long time were kind of bellwethers, right? Seeing as, traditional compounders, new units, productive units, in areas where Amazon, Walmart, mostly Amazon, and then Walmart obviously has really emphasized, their digital capabilities. But what is wrong with this story, or at least perceived wrong with the story from the market, and then we can go from there. Yeah.
Yeah, I mean, one of the main things is for a long time, as I mentioned, this convenience piece, for a long time, the mix of what DG sells kept moving more and more towards consumables. So think of, people stopping in and getting a bag of potato chips or getting toiletries or whatever it may be, things like that, that they're coming in and picking up on the way home from work. And the problem is those categories tend to have much tighter gross margins than some of the non-consumable stuff that they sell. And coming out of the pandemic, early on in the pandemic, when everything was racing higher, right? People were spending a ton of money. DG's non-consumables departments had really strong growth. But they've spent the last 5 years basically comping it with negative numbers against prior year, and non-consumables not really finding a floor. So again, there was a lot of margin pressure that was coming through from that. There was also pressure on the amount of sales dollars going through the box as a result. So I guess overall you could just say it's been a combination of um, AUVs, average unit volumes for those stores, and then the margin profile going forward, and the market having questions about, if they can't get comps back to 2, 3, 4%, can DG deal with, the natural cost inflation that they're going to see on labor and other things, and can they effectively and efficiently manage labor such that they do not have an outsized level of turnover, which obviously then shows up in a customer experience that's underwhelming relative to, again, like what someone like Walmart's doing. And I think Walmart's a really instructive example in a lot of ways because, as I said before, Doug McMillon, in my mind, really being a key critical piece of the company getting to a much better place now, which you can see, well, not to some extent, to a large extent, the stock price. It trades very differently than it used to, and I think directionally, that's the right decision or the right analysis by the market because the company is in a much better place than they were 10 years ago. Part of that story has been Walmart having the perception and certainly to some extent the reality of not having good labor relations and in the US specifically, and them taking the last 5 to 10 years and investing a lot more in wages and doing a much better job at being a retailer, right? And that's something that DG has been behind on. And again, so I think as part of this question of if you're not getting sufficient revenue growth in those boxes, how are you going to be able to invest to fix that? We saw a really prominent example when after we came out of the pandemic, a lot of companies, a lot of retailers started doing buy online, pick up in store, right? Or things where you could go get it in the parking lot because you might not be able to go into the store in a lot of cases, depending on the retailer. When DG implemented that, what happened was employees in the stores are now going and picking product from the shelves and basically doing the shopping for people, right? What, given the constraints in their financial model, effectively wasn't feasible for them. So they've now transitioned it over time to a delivery model that's served through third-party partners, basically, who obviously get a cut of the economics. But point being that DG has to be really thoughtful about our stores are doing like $2 million a box, right? Which is not a lot of money relative. The average Walmart does close to 50 times that amount basically in a year. So you can imagine the number of labor hours you have going through there is significantly different. So they have to be really thoughtful about those constraints. And again, I think they got out of whack with that equation in a couple of years after the pandemic, and the sales volatility around the pandemic certainly didn't help, and obviously supply chain issues, things like that as well. I think they're now getting figuring out the equation and figuring out the path forward.
Then you drew analogies, to Home Depot, in your original piece, I guess. Um, I have some questions on like the convenience and such, but I thought it was interesting when you did bring up Home Depot. Now, if you track the history of Home Depot, and I would, for the listeners' sake, let you obviously share your Home Depot view, but when I step back and I think of Home Depot's journey, they continue to, I guess, grow the size of locations. So, locations kept growing in terms of footprint. And then that led to obviously more category, that they could in theory, capture. And today you go to a Home Depot, right? And you can get toilet paper and, you can get, a Christmas tree, a blower for your, leaf blower, a couple plants and, and some toilet paper and go home. Much different than that. So like, share your Home Depot analogy and, where does I guess the Home Depot analogy, I guess, start and then where does it end as well?
Yeah, I mean the analogy to your point that you're alluding to, like there's very different. These businesses are very, or these retailers are very different in some really important ways, but most notably in terms of what they sell and who they're selling it to. So there's some really important considerations there that people need to think about as they consider this analogy. The part that I think is really interesting is Home Depot went through a period from, if I remember correctly, it's the 15 years leading up to 07, 08, where the store count went from like 200 stores to like 2,300 or 2,400 stores. And if you look at the 15 years subsequently, or I guess 17 years subsequently, the store count today is basically unchanged from where it was in 2007, 2008. So it went from a massive unit growth story to something where unit growth has completely come to a halt. And the CEO at the time, Frank Blake, made a point of the company really needing to stop adding new stores and having so much focus on that as what would drive kind of the earnings growth of the business, to really focusing on the formal economics and running the boxes better than they had previously. And obviously, as part of that equation, figuring out e-commerce and omni-channel over time. So that's kind of what I've alluded to on the DG story that I think is really important. If you look at how does this translate to DG, DG's guidance for 26 is basically for 2% net unit growth, which is the lowest growth rate that they've had in at least the past 15 years. They've remodeled almost 20% of the stores in 25, and they're planning to remodel another 20% of the stores in 26. So I think it's an important shift in terms of management's focus, and I'm sure we'll talk about Dollar Tree as well. I view things like that I think sometimes people view as it's not that huge of a deal. You can focus on multiple things at once. I think a lot of companies struggle with having too many priorities and not really honing in on what really matters. And I think for DG, they got to a place where it became really apparent that putting a lot of time and capital behind unit growth and a lot of management focus behind unit growth really wasn't the top priority. Running the base well was the top priority. And to the extent that you could figure that out and you want to then readjust again, I can appreciate that. But they needed to focus on what mattered first. And just to explain why I just said Dollar Tree there, Dollar Tree on Family Dollar for a long time, which is basically the other direct competitor to DG besides Walmart is Family Dollar. It's a very different business than the core Dollar Tree retail concept. And in my mind, it distracted management for far too long, and they effectively just needed to throw in the towel and admit this isn't working. And the opportunity that we have with the core Dollar Tree banner is very significant that we need to just get rid of this and move on. Um, which they did here relatively recently. So I just think management focus is incredibly important. And you can see in the case of Home Depot in terms of what it then led to in terms of their per store results, especially if you comp it to someone like a Lowe's, they've really meaningfully outperformed them, generally speaking, over the last, call it 15 years. So I think there's a similar type of opportunity at DG, with again the caveat that they're selling different things than that leaf blower or lumber, right?
For sure. Now, to play a little devil advocate on the convenience side, you mentioned Walmart. You didn't really mention Amazon in the same, vogue. Um, where we all know Amazon is clearly trying to push same day slash 30-minute slash whatever. Um, I tend to try to think 5, 7, 10, 15 years, not necessarily who's going to win or whatnot, but like what is gravity pulling many of these things, grocery slash, some of the more non-consumable related products that you can wait a day, or some stuff need to get there that day. But I think of Amazon. I would love to hear your views on them. But then there's Target to some extent, but that is depending on the location and whatnot. But then alongside that, there's companies like Five Below. There's companies that play their own little space. I think they've carved out their own niche within kind of the low cost dollar store-ish type of purchase. And then I think what is under potentially appreciated, not by you, I'm saying just by in general, is your gas station turning to convenience store and much larger, nicer locations that have many of the same things that you would find in a dollar store to some degree. How does it, i.e. there's a lot of circling competitors that either have no footprint or low footprint or expanding their current footprint to try to serve the same thing, which is convenience. And is the question is like convenience no longer unique? And maybe that's not the answer today, but 5, 7, 10 years from now, will all of those kind of be encroaching on the convenience factor in a way that is just obvious?
Yeah, I think it's a very fair point. I mean, it's one of the most interesting things about retail is you say like who's the competitor to XYZ, and the answer typically is like, well, there's a list of like 10 competitors, and some of them are really direct competitors, probably for everything the company does. Some are more narrow competitors for a piece of what the business does. But as you're also saying, those things are always changing, right? I would say specifically as it relates to Amazon, I would view them historically, let's say over the last 5 years, 10 years, as more of a direct competitor for that non-consumables business, something where you can, you know, potentially buy something, but the idea that you're going to wait, even if it's 2 days, right? You can wait the 2 days to get something, and maybe you're saving a reasonable amount of money where that's worthwhile to do, or you have more variety and selection to choose from than you do inside of DG stores, etc. And that's where, for me, I have been concerned over time about their ability to continue to compete and win in a reasonable definition of compete and win in non-consumables, because that does strike me as the harder piece of the business to defend. I think part of what they need to do and what they have done subsequently is to lean into a lot of the things that Dollar Tree is really good at, specifically in terms of seasonal and things like greeting cards, things with lower absolute price points, because that gives them a little bit of protection in terms of what they're then facing from online competitors. It's worth noting as part of this, DG's average ticket. So the average, when someone goes to the cash register, what's the average amount of money they spend? It's right around $15. So obviously it's not a ton of money. And if the average is 15, there's a lot of purchases that are 5, $10 that I'm still really skeptical on Amazon being able to efficiently serve that type of purchase with the delivery and to have the economics make sense, especially where, a lot of DG stores and customers are located. I'm skeptical that that's going to work, but if when we're talking about consumables and things like that, I think that's going to be pretty darn challenging and has been pretty darn challenging. That said, if they're adding, I see they're now testing more of kind of the add when you go to checkout, hey, you can add, whatever, I'm gonna say a loaf of bread or something like that to your basket that you really couldn't do that previously. So definitely a fair point in terms of continued evolution and change over time. Um, what I was saying a moment ago on delivery from DG, they also need to respond, right? They need to have their own continued evolution and improvement. And I think they've now got that to a place for someone who's really focused on that new definition of convenience and is willing to pay a small amount of money to have that happen. I have it in one of my write-ups. I think it's around $5 for this delivery. DG said on their last call, more than 70% of their online orders they get delivered to the customer in under an hour. If the closest Walmart's 25 minutes away, Walmart's gonna have a hard time getting deliveries to the customer in under an hour. So there's certain things of their real estate position that I think still translate to kind of an omni-channel world. But yeah, it's continuing to evolve and change over time. So DG is going to have to continue to evolve and change over time as well.
Yeah, for
One other
sure.
thing, one other thing that's worth noting, again, this is another one of my write-ups. I looked at, as I said before, Family Dollar was Dollar Tree sold Family Dollar. Before they sold it, they announced a pretty significant change in the store footprint where they closed, if I remember correctly, something like 1,000 stores. And there were certain articles that had, hey, here's a list of 20 stores that are closing in a given state, let's say. In one of the articles I wrote, I went and looked at, here's the address for this Family Dollar store. Let's look on Google Maps and zoom out and see what the landscape is in terms of grocery competitors. Let's say a Walmart, anything like that, a DG. What you find in a lot of these cases is DG is located in a way that the Walmart is, again, 15, 20 minutes away. And, I just think you have to ask for someone who is going in for that, again, call it a $15 purchase, or it might be someone who is heading home from work and wants a frozen pizza and a bag of chips or, 2 liter soda. I think you just got to really step back and go, how much of this is actually able to be competed away? How much of it is even more convenient to have to kind of figure out how to do that through an e-commerce solution or something versus just walking into a DG and having that picked and paid for in 2 minutes, right? So I think what they do is very defensible, even though it unquestionably is getting chipped away at a little bit on some of the margins.
Yeah. Yeah. Makes sense. And, obviously new categories can emerge where, they continue, older categories, fade and, get eaten up by Amazon, and newer categories that are, again, where convenience is much more of a factor. And, while there's competitors turning on, there's also, historical competitors turning off, like Party City kind of, going away. And, we find ourselves going to a dollar store to get a bag, for a gift or something like that. So there's always this convenience factor. I just, again, try to think through the eventuals, and, one eventual that is likely to happen, and you would say in rural areas more so than non-rural are, the drone economy, right? Where you can go 25 miles fairly quickly. Not to go into drones right now, that's not the purpose of this, but going to the quarter, your recent post here that I think you posted something here, this past Monday or, recently, let's say, depending on when this podcast goes out. And one of them was, you definitely saw a pickup in the business. You highlighted how traffic picked up, and pricing was less of the driver, or if not the driver of comparable sales, same store sales for those listening. Now, like, what's your view on the why? I have some, takes and ask some questions on it, but what's your rationale behind the why, same store sales has finally, turned positive, and traffic, which is obviously the lifeblood of any retailer is getting people in the door and then trying to upsell them.
Yeah, I mean, I think there's a couple of different reasons. I mean, I think some of it's just the blocking and tackling, kind of like I was saying before. I mean, I think they just got to a place where, and again, I think people understand when they shop these stores, as with anything in retail, there's a level of let's say quality, for lack of a better term, cleanliness, number of employees around to help you. People have an appreciation for kind of what that range looks like. But I think even DG got to a point where they were outside of the range that customers reasonably expect from them, given the constraints of the model. So they had to get back to a place to fix that, right? And it's kind of not to go on a tangent here, but it's one of the funnier things when I think about things from like a regulatory perspective and people, especially when they talk about dollar stores saying, you know, the issues that they have with these companies, and you look at it from the perspective of a shareholder and an investor. It's like, well, you guys have competition coming at them from every angle, right? And to the extent that you don't run your stores well or treat your employees well enough, well, customers and employees can both leave. So I think to some extent they've dealt with that, and to the extent that you don't address those things, you're going to go out of business over time, or you're going to lose profitability, whatever you want to call it. So you'll pay the price for that in due time. And I think to some extent they were dealing with that issue, and they've now got it to a better place. Um, there's probably some macro stuff in there as well. I think they typically see when things get a little tougher, kind of as I was alluding to before, the size of the basket can shrink a little bit, and the number of visits people will then make as a result can increase because they're stretching, when they're getting paid, or whatever it may be, a little bit more than they might be otherwise. Um, they've done a better job in the non-consumables piece, as I was discussing. I think apparel has been something that they've kind of moved out of more, which I think was probably a really intelligent decision, and they lean more into kind of the home and seasonal stuff, that's where I think they can reasonably play and still do a good job. And to the extent you keep the price points low, right? You can a 5% price difference on something that costs 250 is a lot different than a 5% price difference on something that costs $25, right? In terms of how it's perceived and how much value you're putting on the convenience of getting it right now versus waiting 2 days. So I think they've thought about those things a bit more intelligently, have kind of changed the SKUs to get that aligned with where they need to go. So yeah, I think there's a couple of different pieces that have got them here.
Do you ever think of this just came into my head when I was reading it was obviously Temu Shein with the de minimis ruling from a logistics standpoint, they weren't allowed, they essentially shut off their US business for a little bit. Did that play any factor? Was it playing a factor, like 2 years ago, where people, questioning the story, given that fact that you had these, I always say the dollar store of the internet. And, these are the comparables, and they've kind of shut down in the last year. So, you had negative comps for about 2 years straight. So you had a, favorable comp that you were going up against. Plus you kind of had these $2 stores of the internet kind of get taken offline, somewhat. Does that play in your brain at all in this, or is it, you do think it's more of a, just cleaning up the story themselves, and it was more them than it was, the environment around?
No, it does. It does play on this gets back to what I was saying before, right? Like, it's retail. There's such a range of who the competitors are and who the customers are and how they're shopping. So I think there's no question that there's overlap, right? The question is, how much overlap is there between them? I think particularly at the height of things like a Temu, that amount of overlap was getting overstated. I remember things with Bloomberg articles citing credit card data in terms of what percentage of, DG shoppers are Temu customers and things like that. I think it was getting framed a bit out of whack with how I think it truly works. But again, they're also certainly competitors. I wrote in an article. I think it was more focused on Dollar Tree. I looked at something like party supplies and looked at, you can go on Amazon and search for party supplies and rank by the costs of the products. And I think I showed in the one article, there were like 5 or 10 SKUs on all of Amazon when you search for party supplies that were priced at less than 250 or something like that. And those products also did not have the capability to be shipped through Prime. So, and again, similarly to Temu, right? If you're talking about something like buying party supplies and you think about how the average person shops Dollar Tree, they're going in there Wednesday or Thursday or Friday to buy something for Saturday. It doesn't work if Temu says, hey, you can save some money or have wider variety, which is relevant to the question, but not if it's going to take 3 weeks to get there. So I think a lot of this comes back to, and this is where I think a lot of my conviction in Dollar Tree specifically has been kind of rooted as someone who shops there and sees how people shop there, and someone like my mom or just walking around the store and looking. I think the way that it's shopped and who their competitors are, there's again a lot of overlap with a large number of the SKUs in the store. There's also a piece of what they do that's really unique to Dollar Tree. And as they moved into this multi-price strategy that they've been running over the last couple of years, I felt like it would give them the room to continue to run that strategy, but even in a way that's more effective as they removed a little bit of the constraint that they were feeling on, especially at the $1 price point. Their ability to serve categories like seasonal, it just got really constrained when you can only sell things for $1 versus now, if you go walk in and look at Halloween or during the holiday season, they can they can they can merchandise the store much better in a way that is a better experience for customers and still have it work out for the business as well. And I think you're seeing that now in the results. So again, I think all these things are competitors. It's just like, to what degree are they competitors? I felt like it was always overstated, at least where it was at that point in time. Obviously, it can continue to evolve and grow. Um, but yeah, I think it was a bit overstated, but still relevant.
Yeah, that makes sense. I mean, the only thing, clearly not direct, but it's, I guess the competition is really about how many dollars are in someone's wallet and, where do they allocate it to versus, hey, I'm choosing this over that. And I'm no longer going to that. It's just, hey, I don't have any more dollars in my pocket left. And therefore, because I, kept spinning the thing on Temu and, it'll be here in a month. So yeah, I mean, there's some of that for sure. Now, you highlighted, and I think this is, fairly industry wide. We don't have to elaborate too much, but it's, for the sake of the listeners, is shrink in the industry and retail is starting to come down. I think cities in general, during COVID, this was a big problem. Best Buy and some others, just after that, there was a lot of retailers out there essentially, articulating how shrink, meaning essentially the amount of your inventory that is in many ways wasted. Some of it is theft, right? A lot of it is theft. It was theft, at least post COVID. So wasted returns, stuff like that. That's why you have like the open box stuff mandates at, Best Buy as they try to, offset some of the shrink where someone buys it, sends it back and whatnot. But, Dollar Tree, Dollar General, I think we're seeing the same benefits. So that's good for the industry. So I think if you're investing in, these retailers, think there is this margin story that is happening, mostly on the shrink side. Mind you, that you have to counter it somewhat with, some of the tariff stuff that has, been pushed through. So there's kind of this balance there. But going past that, Dollar Tree versus Dollar General, just share a little bit about how you contextualize the two. Um, like, what is that main difference in your view? Because we are seeing a little bit of a diverging trends, let's say, in the numbers. And this is me just reading some of the stuff that you wrote. And so just, elaborate a little bit. How do you view the two differently or the same? And then, why is it seemingly looking like, Dollar General has hit potentially an inflection point, while Dollar Tree potentially is, not sputtering, but, um, not as inflecting, positively, even though I think they were performing better, heading into this anyways.
Yeah, that's a good question. I think it'd probably be helpful if I provide, especially now that this is, a little bit more in the past than it was previously. I provide a little context on how, at least from my investments, like how I've navigated this period. So I owned DG into this period where they came into a lot of margin pressure and the stock has been hit very significantly. And as I said before, I think it got down to 60 or $70, somewhere around there. And I think it was at 130 or 135. So it's had a fairly significant recovery from where it was trading at, but it also got, absolutely demolished in the period leading up to that. Um, I've held it through that period. As I said before, everything I do is disclose to subscribers before I do it. So someone can go back and look and check this. I think to the extent I added more, it was small additions. I have not added significantly through that period. I've largely just held on. And again, it partly was around some of these questions on non-consumables and what that piece of the business looked like going forward. What does that then do the profitability for the box if that comes under pressure? For a while the delivery piece wasn't as clear as I think it's starting to be now. So long story short, there were a sufficient number of questions about kind of the core model and the ability to evolve that put me in a place where I was still comfortable continuing to own it, but I was less comfortable really aggressively buying more. Contrast that with Dollar Tree. I followed Dollar Tree for a really long time, but then as I said before, I never owned it because I always felt the Family Dollar issue was significant and was too much of a draw on management's resources that I just didn't want to get involved until they effectively fixed that. You go through the period where they break the buck and go to $1.25, and then they start doing multi-price. That was a really interesting change that I started to follow more closely. Then they brought in Richard Dreiling, who used to be the CEO of DG. Moving forward, announced that they're going to sell Family Dollar. For me, that was kind of the moment where, okay, now I see all the pieces coming into place. Um, Stock got hit really hard in the back half of 24. I think it got to 60 or $65 a share. And again, people can go check this. I had started buying, I think in mid 24 and in late 24 when it got hit really hard, I swung a pretty big swing, and made it my largest position. And the stock has done fairly well subsequently. So obviously it kept getting larger. So I guess my point in saying all that is my conviction on what Dollar Tree's retail model is and its point of differentiation and its ability to continue to find a path forward, I think has been. I've had higher conviction in that view than I have with DG. I've had questions at times about DG. I still feel good about it, obviously, because I own it. But on a relative basis, Dollar Tree has been the one that I've been more confident in. And again, comes back to this question of what is Dollar Tree's core purpose and who is their customer base. And I think if you look at, most Dollar Tree stores, think of the ones around me, one's in a plaza with a Publix, which is a regional grocery store. Another's in a plaza with a Target. Another is in a plaza with a Walmart. And these are ostensibly their competitors, but they actually sell something and serve a purpose that in a lot of cases, I would venture to bet that someone may be walking into both of those boxes and it's actually supplemental. So
That's your bull case
again,
right there. I mean,
yeah,
you just
yeah,
kind of you're saying, all the competition stuff that I asked earlier. I mean, that is it, right? They're right next to a grocery store, so they're clearly carving something out. They're next to a Target, they're next to a Walmart. I mean, why in your right mind would you park next to, what I am over here, saying potentially a competitor, threat to the business. That's an interesting survey. Is like, someone walking in there would be like, why aren't you walking in Walmart and getting the, whatever you're getting? Um,
right. Well, and I think about it too. I mean, this is stretching it somewhat, but I think this idea is relevant. You think of like a Floor and Decor, which has had a lot of success in flooring, and you think about them compared to a Home Depot, and you can kind of ask yourself, like, well, why has Home Depot allowed Floor and Decor to take a lot of market share in flooring? And I think the answer is because Home Depot's serving a different purpose, right? I mean, they play in flooring, but they're not just a flooring retailer. They have a bunch of other categories that they're serving in their boxes. And, they have a certain view on what their strategy is, and which, by the way, has worked pretty darn well over the last 10, 15 years. And they're not trying to be everything to everybody. And I think the same applies in a lot of ways to, again, like a Target or a Walmart, how they think about what they're trying to do and how they think about convenience and value relative to how someone like the Dollar Tree thinks about it. So I think that's where a lot of the opportunity lies. As I said a moment ago, I think when they broke the buck, it gave them the opportunity in a lot of the consumables categories. Think of something like aluminum foil. I think it was an opportunity for them basically to take just about every penny of that increase from, say, a dollar to a dollar and a quarter, and to put that back into the value of the product. Make the packs, make the square footage 30% larger, whatever it may be. Stay really competitive in those categories on the quality of what you do. On some of the non-consumables and seasonal products and things like that, I think it gave them the opportunity to really open up kind of the wallet that was available to them by having a higher quality of product that they couldn't service previously. Um, you have some examples kind of that fall in between those. One really prominent one that they discussed on their investor day a couple of years ago was a bag of ice, where they were getting a custom bag of ice made at 5 pounds so they could stay at $1, as opposed to the industry had moved to a 7 pound bag of ice, which became the standard. If you go to like a Publix, it's probably 250 or 299 for that bag of ice. They eventually realized, like, we're having this thing custom made. It's more difficult to do it. And the supplier eventually told them, like, we can't do this anymore. They then moved to the 7 pound bag at a buck and a quarter. And basically, it just allows them to be a lot more efficient than it could be otherwise when you're forcing everything into that one price point. That said, I think it's super important for them to be cognizant of the importance of the low absolute price point in terms of how the customer shops the store. But there is some flexibility to play with that model a little bit. And again, like as a way to add value. Maybe one last thing to add here is another really instructive part of my Dollar Tree investment has been the Dollarama case study, which is a retailer up in Canada. Um, the the competitive environment is quite a bit different in Canada and the US, from what I understand. US is probably quite a bit more competitive, but the the trajectory of what Dollarama did and the way that they also uh, broke I think they call it the loonie, the way they also broke the buck and went to a multi-price strategy starting in, I believe it was 2009 up through today. It's really instructive in terms of what that then allowed them to do and how that showed up in the economics for the stores. There's a lot of parallels there that are I've written about this, but it's worth looking into for people who are interested in the story.
Got it. A couple more, sections here and then wrap up. The capital allocation balance sheet. I think Dollar General was buying their shares for a while. Perceive, from a investment perspective, obviously, it tied up capital into, the share buybacks versus, redeploying it back into, the actual units themselves. Your thoughts on capital allocation balance sheets of those companies, and then, if you want to, jump to how you view the valuations of these businesses. Like, how do you get to that upside that, you think you're looking for? Is it really units and margin, or is it, productivity plus margin, or is it, multiple expansion over time? So kind of those different areas of the question on the investments.
Yeah, we can start with DG. As I said before, DG went through this period after the pandemic where the financials for the business, particularly in terms of the unit volumes and the margins, looked different than it had previously, looked better than it had previously. Um, and during that period, it's always been one of my issues with companies that kind of run capital returns relative to call it like a leverage target, is during the periods where things are going really well, that enables the ability to buy a lot more shares than you would in a normal situation. Those are also the periods where your stock price is doing really well. So you buy a lot when your business is doing great and the stock price is doing great, and then you don't buy much, if any, when your business is struggling a bit more and your stock is doing poorly. So a little bit of a buy high, don't buy low, which doesn't work too great. So yeah, they bought a decent. I wrote it. I can't remember if you have the number in front of you. I think it was a couple $1 billion during the 20 to 22 period. I can't give them too much flack for buying the stock there, because that's not too dissimilar from when I bought the stock. So I think they, like myself, may have underappreciated the kind of short-term volatility around some of these key metrics, particularly on margins. So yeah, they've kind of been digging out of that hole ever since, because of margins coming in so much. They then got caught off sides basically on leverage. So they've been working through that over the past couple of years. That's effectively done at this point, which is potentially a nice turning point for the story. But yeah, it's been kind of painful to work through. Um, Dollar Tree's been a bit different. They did have a stretch where they didn't repurchase shares following the Family Dollar deal in 2015. But they had worked through that by the time you get to the last couple of years. And then when they announced the decision to sell Family Dollar, that also gave them some added, firepower. So they've been aggressively repurchasing shares in the past year or so, more so than I thought they would, and they've done it at something like $90 a share on average, which looks pretty good relative to where it's trading currently. Um, in terms of the valuation on both of them, I think the one thing they had in common, particularly as you get to, late 24, early this year, is a lot of pessimism priced in, whether it's tariffs or competitive issues or, all these things that kind of come together to make you question whether or not the margins in particular would get back to where they have been at one point in time. There was a lot of pessimism priced in, and that's lessened to some extent, but I still think it's fairly pessimistic, relative to the potential of the businesses or what they just delivered historically. So, obviously that depends on them actually delivering the results. The key drivers on each name, DG is more of a margin story in my mind. Getting back to, this year they're at, call it roughly 5% EBIT margins. That should be, call it 200 basis points higher than where it is. And obviously going from 5% margins to 7% margins is a big change in terms of the amount of EBIT dollars that are flowing through. So it doesn't look particularly expensive on kind of current profitability. And if 5% margins are 7 or 8% margins in 3, 4, 5 years, then obviously that's a massive lift to earnings and DPS as a result. So that's kind of the main thing. And then on the sales side of the DG story, it's really, again, the ability of these remodels to drive, sufficient same store sales growth, thus that they can kind of leverage the expense base. So, I think we're in a pretty good place in terms of that story playing out. That's really, in my mind, the reason why the stock's done so well. And I think I mentioned the article, right? That goes up, I think it goes up 30 or 35% just in the past month. So there was a lot of incremental confidence that piece of the story is coming together after the market maybe not buying it when management kind of first started talking about these things a couple quarters ago. Um, Dollar Tree, I view it differently, and it speaks in terms of the margin profile. I view it differently than what I referenced earlier on Dollarama. If you look at that story from the start of that multi-price again, like 2009 to last year, you're looking at, over 1,000 basis points of improvement on gross margins and on EBIT margins, which obviously is a massive lift. I've always cited the Dollar Tree story as multi-price affording them the opportunity to make a bit more investment, whether in terms of the product, how much value someone's getting for that $1.25 versus the dollar, or some of the things in the stores where they've admittedly also had a bit of deferred maintenance. And again, I think there's an appreciation among the customer base of what they're paying for and how the stores need to look, or how fast it needs to be when you go to check out. I think there's some reasonable range of what people expect there. To the extent that Dollar Tree wants to attract an incremental customer that may have slightly higher standards, they need to do a little bit better at some of these things. So I viewed it mostly as opposed to that 1,000 basis points of lift that Dollarama is seeing through this process of transformation. Dollar Tree having something much less than that, at most a couple hundred basis points, with a large majority of the improvement basically reinvested. So the driver there will more so be sales growth, with a lot of help from ticket. Again, in the case of Dollarama, you're looking at something mid-single digits in terms of ticket lift from mix shift to these different products, and hopefully a little help from traffic as well. So, and they can also get back to, I should also mention, to the point on the balance sheet being better and the strategic vision being clearer post Family Dollar. Dollar Tree got to a point where unit growth for the core banner had really slowed from where it had once been. And I think as they now figure out multi-price and the unit volumes flowing through the stores is moving higher, it puts them back in a position to go play offense in terms of unit growth. They're at about 8,000 stores. I think it's pretty reasonable for them to expand the base at at least 4 or 5% a year over time to the extent that that becomes a major focus. So all those things in combination with, repurchases at prices that have looked pretty good, at least, 6, 12 months ago, sets up for a pretty good equation.
Got it. Cool. That is a full, complete story here. I think, summary for me is, if you're looking at Dollar Tree or even, Dollar General, we've talked about more here, but in general, you're having this moment in time where, people are questioning the competitive threats. You had a couple mistakes in the past, and you're at a point where they're starting to drive traffic back to the locations. And ultimately, that is likely the number one KPI because, any initiatives they're doing inside these locations, whether it's category specific and or, marketing, channel, distribution, all of that in theory has to flow back to traffic and be your signal that people are coming back to the stores. It's not, they're not driving revenue growth or same store sales just on an increasing pricing. And therefore, as you see sustained potential traffic growth, that'll be the evidence to support the notion of, what you're suggesting here. And then obviously just being aware of the competitive threats that are around them. But I think you made it, when you brought up that they're next to, some of their competitors, it makes you question that that bear case. And if it works there, obviously there's 21,000 locations, so there's a lot of locations. So not every location's, the same. But I think that, for me listening to you and reading some of your stuff as well is the key KPI that I would be tracking is traffic. And, that's a normal KPI to track in retail, but there's also, when you're talking about a story that is changing, it becomes even more elevated of a KPI to track than margins or anything else, because ultimately it's about, people coming to the store and approving management's changes. So yeah, I think that's that. Now, for you, just wanted to, give you a moment here to share a little bit about, where to find more about you. I follow you online and I think it's a good place for anyone out there that either wants to have idea generation and or full-blown idea, creation, let's say. And anyways, just wanted to give you a second here because I definitely appreciate the time. And we've been trying to do this for a while. And we've kind of been delaying it, putting it off, waiting for earnings to happen so that we have more, insights to share, and then, holidays, this and that. So number one, appreciate you coming on. Number two, tried to, flush out the story in the simplest way. And then number three, if you could just share where people can find more about, TSOH and what you're doing.
Yeah. I don't know if it's a good thing or a bad thing. We've been trying to do this for a little while. We talked about two companies where the stocks have kind of gone on a little bit of a crazy run. Well, I can confirm two things. One, that we've been talking about this for a long time, and two, that doesn't always happen. So
For sure.
it's pretty rare for things to move like how these two names have. Again, with the caveat that they went through a pretty rough stretch leading up to this period. So everybody should take everything that we discussed with the appropriate, considerations.
Sure.
Yeah, the best place to find me is over at TSOH Investment Research. Again, as I said before, I worked in the industry for 10 years, basically. Left to start this full time. I publish something every Monday and every other Thursday. And the content is, deep dives on new companies, updates on companies that I've looked at previously that I may consider investing in. Like the one I posted today was on Build-A-Bear, which is a really interesting story of a company that was effectively priced for bankruptcy at the low and during the pandemic. Obviously, for a long time mall-based retailer, that was not where you wanted to be in the world of retail, and that has kind of since refound their footing. And a stock that was at a buck at the lows in 2020 is now at, call it, $55 a share. So again, like I look into a lot of stories that I find interesting for one reason or another. Periodically, there'll be one-offs. A lot of times they're usually kind of the starting of an ongoing journey of what is this business? What are the key things I'm kind of looking at to potentially invest? I think the Dollar Tree example is a really good one of I might follow something for many years waiting for for one thing that I think is really important in combination with the right valuation. Obviously, that'll then take me from having been on the sidelines to being 5, 10, potentially a larger percentage of the portfolio. So yeah, that's all shared as transparently as it possibly can with people. If anybody ever has suggestions on how to make it more transparent, I'm happy to listen. But yeah, so that's the best place to find me. Or people can look on Twitter if they want to. I post a bunch of charts and things at TSOH_investing.
Awesome. Alex Morris, TSOH, investing, research, appreciate you coming on today, and we'll do it again and catch up on a different story and, see where we are, 5, 6, 7, 10 months from now.
You too. I should say for anybody who's not watching the video, if there is a video, you have a very nice bookshelf behind you with a lot of great books, but I'll have to send you a copy of Buffett and Munger Unscripted to add to your bookshelf there because
There
that's
you
the only one
go.
that's missing.
I will start with that. I'm gonna redo the entrance of this thing and share your book. Everyone go get
That's all
it.
good.
I got the Munger book. Innovator's
That's
Dilemma
a
and
good
some
one.
others over here, but got my Ray Lewis, so I know you're a Gator. So you
Yeah,
don't
yeah.
appreciate that one as much, or you can't even see it actually in this. But awesome, man.
Well,
Good stuff.
I'm a
And
big Ravens fan as well, actually, because of Ed Reed back in the day. So our season just ended last night because we lost to the Patriots. But I'm a big Ray Lewis fan.
there you go. Yeah, if I had to choose, one team in the NFL that I like the most. My Miami people will hate me for it, but it's probably the Ravens because there's a lot of hurricanes historically on them. So, um,
Yeah, well, Dolphins and Ravens are both done this year, so
cool. All right, Alex, appreciate it, man.